What's going on there? It's Tuesday, June 7th. I'm Frank Curzio, the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. So we just came back from Orlando. They had a basketball tournament this weekend. You know what? A lot could be said of the economy by just watching the things around you, especially this area, which is one of the biggest discretionary spending areas on the planet. People love going on vacation in Orlando, right? Disney World, Universal. And Orlando's about 2.5 hours from my house, so it cost me easily over $100 to fill up my car each way, which is insane. The average price, this is yesterday, a record high of gas, is $4.89, so approaching $5 on average, more than double what it was a year ago. And it's been pretty crazy on my end. I just put it together, this incredible deal with the metaverse, purchasing $5 million virtual real estate in TCG World, doing a capital raise. It's the largest virtual real estate purchase, although I'm starting to see more and more large real estate purchases go through. So I reckon it's going to hold, like I said, just for a couple of weeks, most likely, just because I'm in this space now and talking to so many people and how big it's getting, right? Getting involved in the right metaverses is key. But being so crazy and nuts, I wanted to spend an extra day in Orlando with my family. So I took my kids to a water park, which is Aquatica. They have about 3 or 4 main ones there. So this was Monday. This was yesterday. And surprisingly, it wasn't that crowded. The streets, the stores, restaurants also in Orlando were not that crowded the whole weekend either. I'm not sure if that's because of the lack of international travel. I mean, I've been going to these parks easily for 12 years, 4 or 5 times a year, because, again, it's really, really close. It's easy for us to get there. So I've been living in Florida. And the demand from international, just the guests, I would say the parks, usually at least 50% of people that you'll see that aren't speaking English. And it's cool. Like, everybody's taking their families there. But, you know, there's a big international presence there. Very, very big. And it's not really there right now. You look at energy prices at record highs, which is pushing flights up enormously, and flights are now record highs. The cost of flying is a lot more. Maybe that's it. I mean, you could book flights a little bit early, save a little, but it's not easy. It's not easy, especially if you're traveling internationally. I've traveled internationally, I think, twice now. I'm going away again internationally pretty soon. But it's not easy because there's different COVID policies. And they're pretty strict in some places, and others, you know, U.S. have eased for the most part, but not really Europe and Asia. They've eased, but not to the point where it makes it easy. So, yes, you could buy your flight early and purchase insurance, but family is still concerned with what happens when you go on vacation, which is really expensive. I think it's like close to $10,000 now just to go to Disney. $10,000 for a family to go to Disney, family of 4. Think about if you have 5, 6 family members. It's insane. But imagine booking that internationally, and if you get COVID, that's one of the things I worry about. It could be a mild case and not even that bad, or one of your kids get it. Now you're forced to stay here for how much longer? Depending on the policy of going back, it could be another week, could be 10 days or whatever. So you get that negative test. That adds a whole another area of uncertainty. That's why you're seeing, even for U.S., you're not seeing a lot of people travel outside the U.S. because of that. If you get COVID someplace else, you're forced, maybe you're in quarantine depending on the area it's in. It could be a real pain in the ass, so I could see that. But you definitely see it in Orlando. You definitely see it in Orlando with shops, stores. There's not as crowded as it used to be, and this is peak season. This is peak season. But more importantly, what does that mean for these businesses? And again, I want you to learn to keep your eyes open. That's why I kind of wish I taught economics, because they make it so boring with bell curves and all this bullshit. But economics is just fascinating to me because you can just look around. It's everything around you. You know, what kind of cars people are buying, your neighbors, are they building houses? Are they fixing up their homes? Are they getting fired? Your friends, family, this all factors into how much you pay for things, apparel, milk, groceries, food, energy. Okay, this is what the economy is all about, and you could see it. You have a significant advantage over people who work at the Fed. One is they're not in tune with the average consumer, right? They're just, scholars and reading books, and this is the way it's supposed to be. Like I said, throw away every single investment book you ever read because it's meaningless, because this time is different. I know people say, well, it's not different. History, right? It's different. Interest rates were at zero for 12 straight years, basically. You didn't throw money at every single problem. No, in 2000, when the market crashed, you didn't see, when technology stocks crashed, it took 3 years to get back on its footing. You wiped out a lot of the bullshit, and then you see the real tech boom actually start. All survivors are massive companies today. That usually happens in business. Get a trend, people get in it, they make a lot of money, then all of a sudden you got the secondary, third players, fourth players come in, all bullshit. Scams happen, all this garbage. Then you see a complete wipeout, and survivors usually are the ones that have massive market caps, start hiring tens of thousands of people. We see that time and time again. Here, we're not allowed to let any company fail, and we're not allowed to have a recession ever. That's what happened over the past 12 years. No recessions. We're not allowed to have a recession ever. Ever. Can't happen anymore. It's against the rules. Why? Because the Fed is a political organization, and nobody wants a recession under their watch because most people are going to vote with their wallets. There's a different world. Now it blew up in their face. That's why the Fed didn't see. You're able to see this stuff a lot quicker than the Fed. That a person listened to this that didn't see inflation coming 18 months ago, at least. And the Fed's like, it's got to be transitory. It's got to be low. They said transitory when it was just at 2%. We're at 8.5%. Do you know how big of a difference that is when it comes to economics? This isn't a stock that overshot. I mean, this is the whole economy. The inflation is insane. It's significant. They didn't see it. The trillions of dollars printed, COVID, everything's going to be okay. We're going to lock down everything. Just hand checks and loans to everyone. We'll be fine. Trillions. They didn't see it coming, but you could have saw it coming. And you did see it coming. So what happens is you take the punch roll away, and now inflation's the worst thing in the world. It's one thing the Fed can't control by throwing money at it. And that's why you're seeing all this confusion. Stocks getting nailed. Look at home prices continue to go higher, which is crazy. People think the market's at a crash. Inventory levels still near record lows. There's hardly any inventory. So rates are going higher, but prices are going higher as well. Which you normally don't see, but that's what happens when people are looking to buy houses. And yes, demand is slowing now that you have mortgage rates above 5.5% from 3%, what, 9 months ago? But still, they're holding that pricing power because not a lot of inventory. So you've seen all these crazy things going on in the market that you've never seen before. You're like, holy shit, my company just put in 2 straight quarters of solid earnings, and it's down 25, 30%. A lot of stuff doesn't make sense. This is what happens when you see deleveraging in the marketplace. Now, getting back to economics and seeing what's around you to determine how you could buy or sell stocks within your portfolio and take advantage of things. And getting back to the Orlando example with Aquatica, but you're looking at companies when you're looking at international or they're busy, you're seeing slower traffic. How do they make up the difference? They have to raise prices and raise prices significantly. That's what you're seeing at these parks. I mean, Aquatica, they did have a sale for tickets, which I was able to buy them 50% off. They're like, this day only, and then it ends the more they say, which I was very surprised. But one day for 50% off because it's peak season. Usually you don't have to do that. But there's a reason why they did that, Aquatica. Because once we got in, that's when they fucked us. Sorry to say it that way, but it's true. Small bottle of soda was $5. Small water bottle is $3. If you wanted a Bud Light and wanted to have a couple of beers, $11 for a bottle of Bud Light. Ate with my family. We got 3 burgers and a fried fish sandwich with 3 orders of fries and 4 fountain drinks. Should have cost us $50, $60 maybe. It was $130. $130 they banged us out. Later on, we got ices where they give you a cup of crushed ice. You have to put your own flavor on it, like strawberry, blueberry, passion fruit. So it'd be a cup of ice, crushed ice. They charge $7. Probably cost them 50 cents for that. $7 each. If you get the burgers, I was thinking about getting a pizza. But the pie was $26 for pizza. $26. So the prices to eat and drink, insane. And the strategy for Aquatica is, hey, you know what? Let's just get these people in the park and we own them. Give them those discounted prices. That's fine. But we'll make up the difference. How? $30 for parking. And they give you a chance to upgrade to so many different things. Food packages, which is an extra $30, $35 each. Where I was like, I don't know if I'll get the food package. Should have got the food packages. At least you could have sodas and things like that for the whole day. Get cabanas, which you really didn't need. You could hang with the dolphins, fast passes, all these upgrades. But once you're in the park, you have to eat their food, drink their drinks, which, again, you're going to get banged out for. And interesting enough, the park was only open till 6 p.m., from 10 to 6. And why only 6 p.m.? Volcano Bay down the block is open till 8 p.m. It is summer. It gets dark, what? After 8 o'clock. But 6 p.m. means you're going to save a lot of money compared to staying open till 8 p.m. I don't know how many people are going to eat dinner then. They're probably going to wait to leave to eat dinner to have a much better meal. So I don't know how much money people are going to spend between 6 and 8 o'clock. They're probably just going to go on the water rides. But now you don't have to pay employees, pay the lifeguards, electricity, cut those expensive things, right? That's significant. But my question is, how much longer are people going to pay these prices? How much longer? And since they're paying higher costs for everything, including your food, gas, and energy, which means you're going to have less money to spend on discretionary items, which is what Orlando is all about. But I'm bringing this up because the news from today, from Target. Target reported terrible earnings on May 18th. 50% drop in profits for Q1. Big surprise. The stock got hit 25% plus and came out of nowhere, along with Walmart reporting a huge miss as well. Then today, Target warned again. Said Q2 margins are going to fall sharply as they have tons of inventory they need to get rid of. And I want you to think about this and why this is significant. So we have these massive supply chain concerns which still exist now because China decided to close everything down because of this latest version of COVID, which is basically, a cold, a mild cold. And if you're vaccinated, you should be perfectly fine. Most people are. Not saying everybody. So got to stay protected of the people who have underlying conditions and are over 6 years old. But really, it was a non-factor for people who have COVID right now. At least this last strand. But massive supply chain concerns. And similar to everyone else, right, with Target. But Target bought a ton of stuff to stock its shelves as demand was soaring. Now demand is slowing. People are cutting back, closing their wallets. And Target has to sell its inventory at steep discounts, which is going to hurt their margins. So stock's getting hit today. It fell from 220 to 145-ish on May 18th when they warned. Then it rebounded over the next week or so to about 168, almost hit 170. Nice rebound, but now it's falling again back to that level. It was down 7-8%. I'm looking now. It's down about 3.5%. A lot of this is anticipated, but Target said, look, this is now. We're going to get rid of this inventory. We have to get rid of it right away. Sell at a discount. But we're going to maintain our margins for the full year and everything should get back to normal. Whether you believe that or not, it's up to you. But you're seeing the stock rebound a little bit. So a lot of the hit was already taken, which is a good sign in the overall market. It's not the worst thing. You won again. You're not getting hit as much. Okay, this Target was down 78% to open today. Now it's about down 3%. I don't know where it's going to close. But you're seeing buyers come in at this level. And there's a reason why. I'm going to bring that up in a minute. But a lot could be said of Target and what you're seeing around you, especially in Orlando, as this relates to the overall economy. So first, what have we been seeing? Companies have been doing everything they can over the past 8 to 10 months to drastically increase inventory because they had so much trouble getting their items and massive, massive, massive demand across the board. So people have more money than ever because they were handed free checks and COVID and trillions of dollars. They have all this money. They want to spend as much as they can and go crazy. Everybody. You know the guy next door. You know what they do for a living, and they have 2 Mercedes in their driveway. And you're like, what's going on here? You're seeing it everywhere, the amount of money that people are spending. That's all cool when you have low inflation and Fed's handing you checks, but now you have higher inflation and everyone's costs are going up, especially with food and energy. So Target, what did Target do? Walmart, they kind of got it right. In all this craziness, supply chain concerns, Walmart and Target got it right. They were able to figure it out. load their shelves with everything possible, right? Increase inventory dramatically, which is fine, right? Demand was soaring. But now what happens when you see, especially discretionary, I mean, not all items are coming down, but in certain categories they are. But now they're stuck with excess inventory when demand is crashing, which means they have to lower prices considerably to unload this inventory, or why Target just lowers its margins. So the question is, you could bitch about Target and say, wow, I own Target, what's good, and Walmart, and that's the story. You always want to look at the stories and see how it's going to impact everything else you own in your portfolio. And how do you play this? That's why I say when people read the Wall Street Journal, don't just read the actual story of if it's Exxon or if it's what you want to look, because when you see these stories, they impact dozens and sometimes hundreds of companies. So how do you play this? So some people just look at Target and say, read a story on Target. No, there's a much, much bigger underlying trend taking place here. She asked, how do I play this? With Target, Walmart, two of the biggest retailers. But first, if you want to look at the bad news, you can protect yourself. You see Target stock getting hit again, even though they kept their margin guidance for the second half of the year. Like, see Walmart do the same thing. Lower its margins, at least over the next few months, to sell their inventory as well. And both of these companies have exposure to groceries, which is on fire right now. They have pricing power in groceries because they're still cheaper than going out to eat. So they maintain their pricing power. Walmart does have retail gas stations as well that limit the damage of, with Target seeing what they say, $1 billion extra in energy costs, which is insane. Walmart also, but when you have those retail gas stations, it helps a lot for Walmart. These are areas where prices will continue to rise, especially through the summer. But these guys are going to aggressively cut prices on clothing, home furnishing, beauty products. And when you look at the bigger picture, it's going to impact so many different industries. If you're in Nike, Under Armour, Gap, American Eagle, clothing retailers, look out. Many stores did everything in their power to increase inventory since supply chains were strained, and they're just figuring it out now, especially over the past few months, getting all this inventory in, stuff that they paid for already, and holy shit, now demand's falling off a cliff. So they got to sell these items at a steep discount. Same can be said with autos and semiconductors. The chip companies drastically, building these plants like crazy and going on. I get it. But all of a sudden, it's like a light switch. And we saw with Walmart and Target, who didn't even warn. Now Target, you see how Target is warning for next quarter, which is still 2 months plus away, 2.5 months away. They're warning. That's what big companies usually do when they're going to miss their estimates. Notice how Target and Walmart didn't warn before their quarter, where they reported on, what was it? The 17th and the 18th, I think back to back. It happened so quickly, it was insane. But think about all these companies that increased their inventory because they had such supply chain concerns, and they figured out and said, okay, just full demand, we'll take everything you got right now. All this stuff's getting delivered at a time where prices are coming down. You think everybody's going to buy an EV vehicle? I mean, Elon Musk just came out and said they're going to be, 20-30% more due to costs? You know how much these vehicles cost? It's super expensive. Super expensive. To the point where it's not going to make up so much of the difference in gas prices. Maybe now, with prices still going higher and higher. But everybody was buying an EV. Everybody has these orders, and you had to put, $100 down, $200 down, maybe a little bit more? You think all those orders are going to get filled now? No. Not only that, the auto companies really were talking up we're going to be the biggest EV maker in the world. Ford, GM, Honda. You look at all across the world, Hyundai. All these companies. Volkswagen, Solaris, all of them. They're basically telling you that every car that we have as a gas guzzler is kind of shit right now. And we're going to see massive demand and be the biggest EV players in the world. Which means you're not selling cars right now because everyone's waiting for your EVs, which was supposed to come out 18 months ago, and they're still not out. Maybe you see one or two driving here or there. I'm getting some stories from subscribers saying, hey, I saw EV of different companies. Not many. Hardly any. And what do you do now? You got to be careful when you create the new version of your product, whether it's the first iPhone, the first iPad, whatever. When you come out with the next generation, you can't really talk crap about the previous generation. You're not going to sell anything Because now you have delays getting out your new product, and holy shit, now you're not selling anything. It's the reason why you're seeing so many lots that are empty still in autos. But Ford, GM, look out. Broadcast, Skyworks, NVIDIA, look out. Now, some of these companies, when you look at Broadcom, trading at a 15 forward PE, great balance sheet, which you can use to buy back their stock. Also, look at the yield at 3%. And I say, okay, this is a stock. It's gotten hit not as much as Skyworks has gotten hit. NVIDIA has gotten hit. But it should place a floor, a little bit of a floor there. Well, maybe we see a little bit of a downturn. Maybe they warn. But that's a nice yield, 3%. Buy back their stock, 15 PE. I mean, Skyworks is a 12 PE. Great balance sheet. 2.1% yield. Target at a 2.5% yield now. 13 times forward earnings. You can see why it's coming back. You see Target falling another 20% from here? Do you think it's going to go under 11 times forward earnings and pay a 3% yield? These guys are going to get it right. They got it right during COVID. They got it right the whole entire time, except for this quarter. I hear Kramer on TV and a couple other people, Target's only down 1% now, but they're ripping like the Target. See, it's not limited to Target, just like it wasn't limited to Walmart. And you want to beat these guys up? Wait, you're going to see it everywhere. So at Gap as well, you're going to see so many of these companies warn. It just makes sense, right? You have all this demand and you can't sell anything, which is insane because supply chain issues. So you're loading up and saying, okay, we got to figure this out no matter what the cost is. You spend a fortune to direct it in a certain area where, hey, okay, maybe we're not getting out of China, we're getting out of another area. And now you're getting flooded with this inventory and demand's crashing out of nowhere. And look how fast it happened. It makes sense, right? That's what we're seeing. But those stocks with high yields that have already gotten hit, that are cheap, strong balance sheets, have much less downside. These are the names you should start picking away at. Then these companies trading expensive valuations and don't pay dividends. Chipotle's 40 times forward earnings, no dividend. NVIDIA, 35 times forward earnings, no dividend. You want to own these? I know NVIDIA, I know it very, very well. And I can tell you, one of the biggest things, one of the biggest selling points was when they didn't get the deal done with ARM Holdings. And that was huge for them. That would have created the ultimate monopoly. It was just no way I saw that deal going through. If you really look at the details, it was very difficult seeing that deal going through. The amount of lobbying from their competitors going to the politicians, it was almost impossible for that deal to get through. And the stock ramped up still, went higher, because after that deal, it increased, 40, 50%. It took a while, and then, once that deal fell through, stock still started going higher, but now you see it get nailed. And it got nailed a lot more than some of the other semis, but still, when you don't have that dividend, and if it does have a good balance sheet, so does Chipotle, but, 40 times forward earnings in this market? Pretty crazy. So be careful of those names, even though they're down 25% plus from their highs. It's a different market. One comes with strong balance sheets, but have dividends that have gotten nailed, but are trading at cheap valuations. Not Chipotle, is not NVIDIA. Those are dangerous. So if you pick it away, again, buying those names have gotten nailed already, but have strong balance sheets, pay dividends, along with being cheap. That's a good formula right now. But the good news, this is the bad news, but the good news, the silver lining here, which is very, very big. Okay, we see stocks lowering, margins coming down. We're going to see more companies warning. I get it. Your stock's going to get hit a little bit. But the silver lining here, Target, Walmart lowering prices. Think about that for a minute. That may be the first deflationary event I've seen in 24 months. It's happening not just these small, tiny companies. These are two of the largest retailers in America and in the world. Access to how many consumers are being forced to lower prices. Because they're seeing changes in the consumer. That's good news. It tells us that inflation is definitely moderating. Doesn't mean it's going to come down significantly. Moderating, we need to see moderation. We still haven't seen moderation. We haven't seen the top of inflation and slowly coming down. We need to see that. We need to see it come down a lot more from here. But first, let's see it top out. But in order for inflation to moderate, we must see margins for many companies get hit. That means that they're losing pricing power, they're lowering prices. That's good. And if that's the case, what does it mean for the Fed? Doesn't have to be as aggressive when raising rates. Maybe they get away with raising the Fed funds rate to 2%, 2.25% from, 1% now? Instead of going 2.75, 3%. That's significant. It means just 2 more rate hikes of 50 basis points compared to 4, 5, 6, or what we're seeing from so many firms. Again, hopefully I'm not losing you here with this is what's going on with the market. You want the Fed to slow, and they can't slow unless inflation moderates. And we're finally seeing that. It's not going to happen right away, but over the next few months, yes, it could happen. Because the biggest risk to equities, to markets, to your portfolio is inflation. The one thing the Fed can't throw money at to control. I'm not worried about oil. It's cyclical. Yes, it's going higher and higher, and you see it in record prices. Again, they go higher and higher, and they go low and low, and they overshoot. Okay, it's eventually going to come down as demand wanes, which it will. People are going to drive less with gasoline prices surging over $5 in most areas. Holy shit, $5 for a gallon of gas. That's insane. Business demand is going to slow, meaning less energy usage of factories and plants. You'll see it happen, not right away. But inflation data, which is what the Fed is looking at, and they look at the core, which excludes food and energy, in the months ahead is likely going to show moderation. And food and energy is going to take a little longer. But that's important as we see the light at the end of the tunnel, which we haven't seen. And that's the uncertainty it creates. We're talking 3-4 months now that, hey, we're going to see it moderate. We're going to see it moderate. We're going to see it moderate. And higher and higher and higher and higher for the last 4 months. So we've seen this massive moves in stocks. The volatility is insane. Nothing makes sense. The leveraging, funds getting crushed. It's very hard to put your money to work if you really don't know what's going on or have any clarity on anything. But we see inflation moderate. That's clarity. That provides certainty. That says, okay, we're close here. Now I could really start putting money to work. I don't have to wait about the stocks really, really falling a lot further from here. After a 30-35% moves, if you own SPACs and recent IPOs that came out past 18 months, you're down 70%, 80%, 90% in some of these names. But in order to see the bottom, that's what you need, inflation to moderate. Everything else, it's temporary. The war, temporary. They'll figure it out. Yes, it'll take longer. Energy prices, cyclical. Food prices, yes. Again, they're going to remain higher for longer. But the inflation picture, that is the biggest thing. It's the risk we've been talking about for a year and a half. When Fred started putting in that language of transitory, said they're full of shit, it's not transitory. Now we're seeing why that is so important, because the Fed can't do anything to help stimulate the economy like it did for the past 12 years, which is catching everyone off guard. But lower inflation, definitely a good sign. Again, indicate we're close to a bottom. And when we do see that, we're going to see trillions in cash on the sidelines. Balance sheets are flush with cash. It's going to start flowing into areas I mentioned earlier. Stocks with low PEs that got nailed already, which have strong balance sheets and pay dividends. Let me throw in insider buying there, which you're seeing record insider buying right now. Record insider buying. Something you want to see, which we haven't seen up to 2 months ago, 2.5 months ago, but before that. Massive selling over the past few years. Finally, we're seeing insiders go, whoa, and buybacks. Big buybacks and insider buying. So we want to see when your stock's getting nailed. It gives you confidence. These guys know their companies better than anyone. So we bring this all together. We're going to be in for some more pain at least over the next 3 to 6 months. Doesn't mean you can't invest in stocks. We've been picking away. You see some companies start to lower earnings. It may be factored in like you're seeing with Target, down just 1%. It was down 8% really quick. Again, algorithms kick in. Companies are able to trade the markets before they even open, but it's only down 1%, meaning that a lot of this is being factored in with stocks getting crushed already. Margins start getting squeezed, but the good news, inflation is moderating. There's lots of companies whose stocks are down 30% plus already, which are reflecting a lot of this risk. So definitely worth picking away here, especially if you plan on holding companies longer than 12 to 18 months. It's what I'm doing. I'm looking to sell my house even earlier instead of waiting to move in January and then selling my house. I want to put some of this money to work right away. And there's areas that make a lot of sense. Companies that sell inventory and retailers. There's several companies that do that. That's great. That's an area. That makes a lot of sense. If you're looking at home improvement, forget about refinancing your home, but how about home equities? More money in homes than has ever been in history. It keeps going higher and higher and higher. People are going to look to tap that equity. And what are they going to do? Probably fix up their homes. So the Home Depots I wouldn't throw, or the Lowe's, in the same category as Walmart and Target. It's different. I mean, not everything is bad at Target and Walmart. Not everything. Food, energy, discretionary items, healthcare and beauty and furniture. Some of these things are really, really getting nailed. When you look at the home improvement market, that's going to be on fire. People are going to the amount of equity in people's homes, especially, what were they up? 20%, 25% from last year is incredible. It's incredible how much prices have gone up. And yes, they're starting to moderate a little bit, but with low inventory, they're going to stay at these levels, especially if you live in certain areas of Florida and Texas, which see a massive demand, massive demand, even Nevada. That's an area too. So there's pockets you can look at to put money to work, and you're going to see us put money to work even in our newsletters, which we recommended 3 new stocks in Curzio Venture. Good timing on those 3 new ones. And we're going to recommend 2 in Curzio Research Advisory, which all of our subscribers will get tomorrow after the close. So questions and comments, I'm here for you. FrankCurzioResearch.com. Send them in. Daniel and I are going to take a lot of them. I'm going to have them on tomorrow, so be sure to stay tuned and tune into tomorrow. But getting lots and lots of questions. We're here for you. Again, crazy times right now. Take advantage of it. That's what we're doing here, answering lots of questions, especially with Daniel coming up. And also, I'll try to get some on Thursday with a fantastic, fantastic interview. So great week planned for this podcast. Be sure to stay tuned. I'll see you guys tomorrow. Take care.